right, welcome back to another episode with Sharp Education. Today, we're going to be building on our last trading strategy that, let's show you, it did not work. It didn't work at all, not even close, but it was pretty simple. Two stipulations and a linear relationship that doesn't really exist. You're never going to find a simple set of rules that lets you outperform. Only buy before over the 200 MA or anything that sounds simple isn't going to work. But we're going to add a little bit of complexity. In fairness, this is still going to be a simple strategy, but the idea is it gives you the foundation for making more complex strategies yourself. This is also the idea of the entire channel. My goal isn't that you just copy everything I do, it's that you understand how to extend on top of it. You'll notice that some of the functions we build in our other episodes are extremely scalable. You add the strategy, test the strategy, but the framework is similar every single time. Test the strategy, add the Bollinger Bands, add the relative strength index, so on and so forth. That's the goal, that you can add any strategy you like, and we're sort of just getting you guys familiar with what that looks like. Today, we're going to take our economy.ipynb file. We're going to add a technical indicator. I'm going to be using the MACD, the moving average divergence, and seeing if we can integrate that with our investment hypothesis, where inflation being higher than interest rates suggests an underaccounting of spending going on in the stock market. We know that testing this on a raw basis doesn't really work, but what if we added an additional set of rules? I'm not sure what those rules are going to be just yet, but we'll define them together in this episode. So let's make a new file. Let's call it economic. Okay. So now we're getting really advanced with it. We're using technical analysis with economic context. I already disagree with the validity of technical analysis. I repeat myself a lot on that point. But if you can base it with some sort of economic context, I'll hear it out. If you say, I don't believe in the moving average convergence divergence, but it does tend to do well when there are inflationary pressures facing the markets. That's an educated conversation. That's not just, I saw a fair value gap and it's expected to cover in the next, I don't know. That's all stupid. Don't be stupid. Copy all of this in. Let's go Control A, back to economic TA, add a cell, and Control V. It did not work. Control A, C, V. There we go. That is, yes, exactly what I wanted. I'm going to separate these into separate cells. I'll put this in a separate cell as well. And we're going to run everything to make sure we're in the same place we were at the end of the last episode. All right, so our chart is a little bit different because I did not separate them from our main function here. Perfect. So we're exactly where we ended up. What I want to do is I want to add MACD indicator to this plot. So the plot itself is going to get a bit noisy. To do that, I am also going to get rid of the asset returns of this chart. So let's get rid of that in the legend and in the instructions. So now we just have the federal funds rate and inflation, and I'm going to be adding the MACD. Where do we add this? We can add this in any part of our code. So again, the idea is that this is really scalable. So all we need to do below add inflation is go to the moving average convergence divergence and add the MACD. Control C and paste that in. We also need to get our technical or our global variables for the MACD. So what is our fast value, what is our slow value, and what is our span? Remember that these global variables you can change yourself to whatever you see is the most effective. I don't have a preference. Again, I tend to avoid technical analysis altogether. But if you see something different than I do, I encourage you to dive further into that. So let's go back to our MACD Bollinger Bands code. Take this three here, Control C, paste them back in here. Perfect. And add this to our main function. So once we are done adding inflation, data frame is going to equal add MACD to the data frame. And we should see that when we run this here. So before building a strategy, or I guess we are still running the same strategy, but the idea is I'm going to show you a column that says MACD. That will be right here, the MACD histogram. Now, I need to plot a figure for our histogram here, plt.figure, so that they appear in different plots. I remember the MACD histogram being a particularly slow indicator. There's sort of a lot of calculations going on with the exponential weighted moving average. It is what it is. Yeah, there's a lot of values. For the purposes of this study, we can actually just limit the look back to be 1,000 days for now. Still pretty noisy. Okay, I made an important mistake. I calculated the asset returns before taking the subset, which was never a problem when our look back was 10,000. But when I shorten the look back, that makes our asset returns become calculated before taking our look back subset. So the plot ends up looking pretty strange. Don't want that to be the case. So instead, I put the asset returns calculation after we define the subset of our study. And when I run the function here, the plot should look a lot different, or they should start from the same point at 0. Okay, looks more realistic. So the strategy and market column are starting from the same point. The federal funds and the inflation data are starting from 1,000 days ago. We are going to be expanding this way back. In our MACD histogram, I'm not going to plot it because that takes up a lot of time. But the line chart actually might be a good idea to plot. So instead of doing bar, I'm just going to do data frame, MACD histogram. Title will be this. And I'm going to move this to our final feature. Okay, this is the chart we're looking at. You can see the MACD histogram fluctuates over and under 0. The federal funds effective rate is the blue line. The orange line is the interest in the inflation rate. And the MACD histogram, we're going to add this to the legend. MACD, I guess it's not a histogram in this plot, but the MACD value, we'll call it, is in the green. So what our strategy is going to be, just for example's sake, I'm not saying this is a good strategy that you should follow. It's going to be pretty simple as well. In the last strategy, what we did was we followed a buy, because we have 3 stipulations in our strategy right now, that allows us to, an additional factor, which could just be staying in cash. For example, when 2 factors are conflicting with a third, then we just stay in cash. Or maybe we just wait for at least 2 of them to agree. We can do an unlimited amount of things with this. For the sake of today's strategy, let's take a look at what we currently have, where inflation is greater than the federal funds rate. It's 1, otherwise it's a -1. We're going to change the name of this column to be econ strategy. We're going to add another strategy column below it. We're going to add a technical indicator strategy. Add technical analysis strategy. Call the name of this TA strategy. And where the MACD histogram is greater than 1, that is a buy signal. Otherwise, it's a sell signal. And our final strategy column, DF, or define add full strategy, is going to be the data frame strategy column, which we originally had as the economic strategy. The data frame strategy column is going to be where, np.where, data frame econ strategy plus data frame MACD strategy is greater than or equal to 1, then it's a 1. Otherwise, it is a sell. No. Where the sum of these 2 values is greater than or equal to 1, then it's going to be, depending on whether, numpy.where, the data frame, this is getting a little bit complex, but I'm enjoying it, -1, else 1. Okay, here's my thought process. If the sum of the economic strategy and the technical analysis strategy is greater than 1, meaning that there is some confluence with our inflation being greater than the federal funds rate, and the MACD is also bullish, then we should be going long. If it is short, if the sum of the values is less than or equal to -1, then we should be selling short here, otherwise going long. I think this works, but we're going to give it a shot. So we have to add a couple functions to our data frame equals add economic strategy, data frame, TA, full strategy. We're going to do a full 10,000 day test on this. See how it works. Forgot to return the data frame here. And I cleaned up the function a little bit. So I made the strategy based on a combined version of the economic strategy and the MACD histogram and the technical analysis strategy. So we'll call this the TA strategy. Actually, this should be okay. Plot, very ugly plot. Okay, this is interesting because if you remember from our last episode, you'll notice that we were negative at the end of this strategy. We go back to just economy. But when our stipulations were only the inflation and interest rates, we were actually below zero the end of our study. This can be made more clear if I get rid of the asset returns, run everything. Like our final strategy returns were negative 74%. You can see we're down here. But in the new case, economic TA.IPYMB, you can see that our strategy cumulative returns were 47%. Over a 30-year period, we made money. Not nearly as much as the buy and hold strategy for the S&P 500, but the technical indicator actually did add some value to our strategy. That's awesome. Need to make sure I shifted correctly. Not. We really need to remember to shift. That is a very important part of this. This might change the results completely. But I made the assumption that I knew what would happen to the MACD at the end of the day happened. And I didn't really, so that explains why we were doing well. And it's part of why I consistently avoid technical indicators. It's actually made our strategy even worse somehow. So it's a little bit embarrassing, but it's an important correction to make. You can see that our cumulative returns after adding the MACD histogram, negative 0.78, which I think was even worse than, yes, even worse. Adding a technical indicator made our strategy even worse. You add it effectively. When you use no look-ahead bias, which we've covered in earlier episodes, I recommend going back to one of the earlier ones, like the crossover strategy, to talk about head bias. When you correct for that, you notice that the MACD histogram actually makes this economic trading context even worse. Fascinating stuff. And I'm glad you guys were here to stick around for that initial exploratory analysis. You can add any technical indicator you want. On the Sharp Research Education database, we have several. Both technical indicators, I think there are 4, and combinations of all of them together. That makes about 10 or 12 episodes. That's it. No limit to what you choose to add on top of this strategy, but be careful when running into look-ahead bias and make sure that your simulations are exactly how it would be in real life. This is further evidence as to why I choose not to use technical analysis in my trading strategy myself. The purpose of the channel is to allow you to make that assessment on your own. You don't need to take my word for it, and you didn't need to pay me any money to hear me teach you this. This is benevolent teaching. Thanks a lot for being here. I know it was a bit of a longer episode. Look forward to building on this strategy even further and hoping to find a more useful integration with economic data and technical analysis in the near future. And until next time, stay sharp.